and welcome to the Tearsheet Podcast, where we explore financial services together with an eye on technology, innovation, emerging models, and changing expectations. I'm Tearsheet Editor-in-Chief, Zach Miller. The infrastructure of a crypto-native finance is maturing beyond proof of concepts into real financial products. Tokenized securities are moving from experimental pilots to regulated offerings. Stablecoin infrastructure is becoming the backbone for 24/7 payment systems, and traditional fintech companies are quietly integrating crypto rails to improve settlement and unlock new capabilities. I'm joined today by Juan Lopez, general partner at VanEck Ventures, where he focuses on investments at the intersection of traditional finance and blockchain technology. And before joining VanEck, Juan was at Circle Ventures, giving him a front row seat to how institutional grade crypto infrastructure has developed. His portfolio includes companies building the regulated infrastructure, enabling this shift from experimental to operational. Juan's perspective on where real value is being created, from tokenized equity platforms achieving regulatory approval to stablecoin routing systems, offers insight into how crypto infrastructure is becoming essential plumbing for modern financial systems. We'll discuss what's driving adoption, where the next wave of exits will come from, and how fintech companies are integrating the blockchain technology to improve their core business models. Welcome to the show, Juan.
Thanks, Zach. Thanks for having me. Great to be here.
So I'd like to start with that transition from Circle to VanEck and how that's impacted, I guess, your investment thesis, if it has at all.
Totally. Yeah, so to give you some background, I joined Circle about 4.5 years ago, initially in sales, and I spent quite a bit of time there from BD to product, and ultimately got to found our corporate venture arm called Circle Ventures with my partner Wyatt, who's now my partner at VanEck. While we were there, we saw this whole sort of phase shift from when USDC was under $1 billion in circulation to now over 60 billion, and saw an exponential growth in all the types of different companies, from crypto native to more fintech native and traditional financial institutions that wanted to leverage stablecoins to either move money faster or easier, or program stuff on the blockchain with kind of the power stablecoins. While we were there, we got to invest in roughly about 100 companies building around the stablecoin stack. This was anything from the layer 1 blockchains to the middleware sort of applications that were extending wallet infrastructure down to the end user, and even some consumer applications that were sort of productizing the value prop of stablecoins at the time. So companies like Litio and Dollar App, which now have hundreds of thousands of users and really distribute stablecoins down in emerging markets. In terms of how it shaped our thesis, I would say at the very beginning, we were sort of trying to partner with any great entrepreneur who we thought could help extend the USDC network and could help bring more entrepreneurs, more founders to come and build on our stack. As I started to get more of a crowded market, and we started to see how stablecoin issuers, including Circle, started to sort of shape up the competitive landscape, we started to strongly take the view that the issuance layer will eventually become commoditized, and start to zoom out and think through what happens when issuance becomes overly competitive, when issuers are looking to partner with the Nubanks and Robinhoods of the world to effectively distribute their stablecoin. And what that led us to is effectively to say that we think the pendulum is swinging in this cycle, where there might be initially a supply constrained market where stablecoins were net new and they were not necessarily broadly accessible, and that's what led them to this moment. But now that they are broadly accessible and they're competitive, we think value is actually going to accrue down more towards the application layer. And we can talk about a little bit more about what that means and the types of companies that will emerge. That's a little bit about my background and how we ended up at VanEck with this thesis around the application layer built on top of stablecoins.
Where do you think we are in the full cycle of things? You've seen it from its pretty much its beginning. Like, where do you think we are? If this is a 9-inning game, where do you think we are in the cycle?
Hard to say. I would say in many ways we're at the end of a prior cycle, but also at the very beginning. I mean, it's hard to sort of point where in time that looks like. But the reason I say we're towards the end is we're very much, I think, wrapping up this era of kind of the speculative phase of crypto, as kind of Jeremy Lair calls it from Circle. Or maybe even kind of this overly like nerdy and technically focused side of crypto, which really took focus over the last couple of years when we were building anything from MPC infrastructure to fully homomorphic encryption to CK and all these really novel and powerful technologies that ended up becoming the focus, and we kind of left the product and the customer outside of that. So I think we're very much at the end of that cycle where a lot of that took center stage, and we're now stepping into the very beginning of the next cycle where we think it's not necessarily the kind of the inventors, if you will, right? Like the Vitaliks and Stani from Aves of the world, who were very influential characters and very meaningful. We think now the sort of more product marketing and business-minded entrepreneur takes center stage, the one that can actually take a lot of these inventions and innovate around them and figure out ways to package that for the average consumer. So we're very much at the beginning of that, and I think that gets unlocked mainly through some of the regulatory hurdles that we faced over the years that basically invites a whole new type of founder persona, as well as a consumer that's no longer necessarily quote unquote fearful of crypto because of what's happened in the past.
You just mentioned regulatory changes. Obviously, we have the Genius Act here. Maybe you can take us through what that is and the impact you see having on the industry.
Totally. Yeah, I mean, so there's been kind of a couple of factors leading up to that. I mean, first and foremost, stablecoins to date have been largely unregulated at a global scale, but they've been regulated in different local markets. In the US, that's been mainly through money transmission licenses, but that leaves a lot to be wanted as far as the scale and the promise that stablecoins could have. So for a very long time, companies like Circle and Paxos have actually come forth towards the government to seek regulation. And the most promising, this is kind of the best we've gotten so far in what's the Genius Act. So it finally passed the Senate and sort of marks what we think is like a pivotal regulatory milestone. And it signals kind of the political support around stablecoins, which finally found a really strong narrative in the White House. That narrative being this idea that if they continue to grow, if stablecoins continue to grow at this pace, there will be a meaningful way for us to export U.S. government debt. So what, based on Senate approval and now going towards the House, this poses a question, I think, for most fintechs and financial institutions in the world that now have to ask themselves, what is my stablecoin strategy? I can't imagine that not being in every sort of board meeting. That question is not being asked. So we think stablecoins will continue to sort of dominate the public narrative, and I think the Genius Act will be center stage for companies like Circle, who now get to partner with some of the biggest companies in the world. And the reason I mentioned that is a key point in the Genius Act ends up being this idea that of a non-bank issuer that has to have the stablecoin issuance as the core of their business. So I think one of the things you'll find is, and this is one of the points that was heavily negotiated, I imagine, by the bank lobbyists, is this idea that the Facebooks and the large tech companies of today, they won't get to launch their own stablecoin. They will probably have to partner. So that's obviously very bullish Circle and very bullish other issuers.
You mentioned it wasn't even a major point what you just said, but that like the conversations happening in boardrooms outside of like the big banks, like the JP Morgans and the Bank of Americas, the Wellses. Do you think that banks, for the most part, are addressing this opportunity or challenge in front of them? Is it top of mind for them, and given your conversations with people?
It is top of mind. Definitely so. I think if you look at some of the charts coming out of the Artemis research or the stuff that I think Castle Island and Dragonfly put out, and virtually, if you pick your favorite provider and try to map the growth of stablecoins from a volume perspective relative to FedWire, ACH, Visa, it's really hard to ignore. Like there's a lot of volume that's happening in the stablecoin economy. However, much of that is happening outside of the banks. And I think it's definitely front and center to the extent that a CEO like CEO of Bank of America has to come out and say like, hey, this is an opportunity that we're pursuing. However, when you peel under the hood, I actually don't really think that anybody really has a strategy.
I agree,
and anybody really knows. Yeah. So That's quite interesting. I think there's general awareness that this market is growing and it's something to tap into. I don't think many of them have a strategy. I think from our vantage point, and we've made some investments around this, is it's unclear to us if every bank will want to issue their own stablecoin, mainly because from a competitive standpoint, it might not be a place where everybody can afford to play ball. However, it's very clear to us that every bank will want to accept stablecoins, and they'll want to be part of that acceptance network, similar to how they've joined Visa and MasterCard sort of acceptance networks, and monetize off interchange there. So I think there's a very clear opportunity for, as once there is regulatory clarity and their compliance officers can translate that into what the real sort of operational overhead needs to look like and what their systems need to adopt for that to actually take place. I think there's a really strong opportunity, and this is what we're betting on. There's a really strong opportunity for a stablecoin acceptance network to be deployed at scale. So we made an investment in a company called Ubix that's built by a Citi veteran founder called Tony, and we're just very excited about what that entails for the banking industry that may not necessarily have a stablecoin strategy today, but this gives them very much a very well understood business model in the form of interchange in a growing category like stablecoins.
Got it. I want to talk about Denari. I don't know enough about it, but from what I understand, it's the first tokenized equity platform to receive FINRA broker dealer approval. If you're open to talking about it, I'd be curious, like what their difference in like regulatory approach was and what that type of approval might signal for the broader tokenized securities market.
Yeah, happy to. So just to sort of zoom out and talk a little bit about our strategy and kind of how we view the world, VanEck Ventures is an early stage venture arm as part of the broader sort of private markets umbrella for VanEck. So we're going to have a number of strategies on the private side. Early stage venture is one of them. We also have a liquid hedge fund, and we'll have more down the line. The big focus on the venture fund is really twofold. And it's verticalizing supply chains of payments and capital markets. Those are really kind of the two things that we think blockchains are uniquely suited for. We talked a little bit about payments just now, but Denari specifically addressing this capital market side of things. So, as you mentioned, they were the first to receive a broker dealer that's specifically suited to offer tokenized stocks. And the reason why we think that's a big unlock is it signals, it actually signals how serious the SEC is about enabling this new market structure to emerge and potentially entertaining what this idea of the transfer agent being the blockchain actually means for securities trading and securities accessibility at global scale. So our sort of generalized long-term view is we saw this initial skepticism with stablecoins. People were asking questions such as, you have PayPal, you have Revolut, you have Wise, you have these like really entrenched and highly scalable fintech players. Like, why do you need a digital dollar and a blockchain? And I think we started to build consensus around why that's the case and why that's so powerful. I think the next question to be asked is why just focus on exporting U.S. government debt when we can also export U.S. capital markets in a more programmable way along the same fabric, right? Using the same infrastructure, we can distribute dollars, and those dollars eventually, today they serve a really powerful role as dollar savings and a hedge against inflation in many emerging economies, as well as, it's kind of the world currency for settling trade. But I think tomorrow it's worth asking the question, like, what do we want to do with those dollars, and how do we keep them within the U.S. financial system at a global scale? And we think one of the answers that comes up from that is securities. And when you drill down and sort of ask, what is the right model, what is the right form factor for securities infrastructure to take place, we think it's following very much the circle view of the world, right? Being compliance first, seeking to be licensed, seeking to hold funds for the benefit of end users, and following all the laws and regulations, not just in the US, but at global scale. And one of the first steps to that is they've already got an SEC transfer agent. They now have a broker dealer and FinCEN registrations, and they also have a Bermuda license to serve customers offshore. And we think that regulatory backbone is what enables a company like Denari to end up partnering with the likes of Gemini and Bigo, who they announced earlier last week, and ultimately kind of pave the path for what it means to have. I'm trying to sort of think of what this looks like in the real product form factor, but this kind of like, we call it buy or invest in anything from anywhere API. Something that
any
you can
type of
offer.
asset.
Any type of asset, right? Like something that you can, express to an entrepreneur that it's in Argentina or in South Africa or in Singapore, and they can pick up this API and very seamlessly, with their local currency or local payment rails, access any asset from anywhere in the world. We think Denari could be the backbone of that. They could be kind of the circle of that market, given some of the progress that they've made on the regulatory front. And this is a killer team, and one that's had a number of successful exits in the past, and they're very sharp and they can iterate very quickly. So we're very excited to have back them.
I remember back in the equity crowdfunding phase, the craze, maybe call it. That was the promise, basically, being able to buy and sell any type of asset around the world. But there wasn't a unified technology or a technology layer to be able to make that happen. There was all proprietary platforms. It feels like crypto gives us like you said, an API to do that, as opposed to like specific companies that have their own sort of closed gardens.
Yeah, no, I think that's one of the exciting pieces that really got me excited about crypto some time ago, is that it's not necessarily about the incentives, although that does have a use case, and we can talk about that. It's not necessarily about the maybe self-custody nature of it for me. It's more about this idea that a combination of all that unlocks kind of a really open source platform for a number of these financial applications that have yet to, maybe for different reasons, whether it's because these walled gardens were just benefiting from being walled gardens so much, or because different countries around the world just don't necessarily have the incentive to open up their financial systems for either for capital flight to occur, or for various currency controls that are just in place to keep local currency ingrained within the local economy. I think we finally have this movement that really sort of unlocks an open source API for financial services to be built around the same fabric. That's really exciting to us, and that's kind of why we get excited about some of these investments, whether it be Denari or Ubix or some of the stuff we're doing in DeFi as well.
I want to talk about Stripe's acquisition. So they bought Privy. Never heard it pronounced, Privy. And that kind of showed me that, how embedded wallets are becoming sort of table stakes infrastructure. So from your portfolio perspective, what other crypto native tools do you see? Are there other crypto native tools do you see fintech companies quietly integrating behind the scenes?
Yeah, no, that's really exciting, and it's exciting for a number of reasons. I mean, first of all, Stripe is pretty much the leading platform in fintech, period. I think they run something like between 1% and 2% of global GDP per year. I think at first you could have seen them as kind of an index on e-commerce growth, but now they're an index on AI growth, just given all the AI companies that are building on them. So it's really a fascinating company. And so it's exciting for that reason, just because they are a market leader and they're not afraid to make big bets. But then second of all, because it validates this idea of, can you have a fully vertically integrated payments platform that owns everything from issuance to acceptance and has the right economic model to monetize off of each layer while being able to take advantage of its huge scale. So I think they're definitely making bold moves, and on the path to becoming kind of $1 trillion business, in my opinion. Now, unpacking like what the Privy acquisition actually means, we really think it sort of plays a role together with the Bridge acquisition. So the Bridge acquisition gave them like a strong path towards issuance and acceptance on the card side. And then Privy gives them ownership over the wallet. And I think if you sort of look at the Circle filings and you look at the Coinbase filings and you try to net down the economics of the stablecoin business, it's very clear that ownership around the wallet actually matters quite a bit, and it meaningfully influences the sort of net interest margin sharing formula that's on the back of these businesses. So long story short, it will matter whether you own the wallet or not, because you'll get to influence which products you distribute and the types of modes that you can build around sort of third-party services like stablecoins. And I think, the in a nutshell, Stripe with these two acquisitions is really well positioned to take advantage of the whole vertical stack. And we think it'll be very value creative to them. Now, on the back of that obviously signals to the market, which parts of the stack may be valuable, which may be backable, and which may sort of come down the line. One of the things that we're very much investing in and quite excited about is when you sort of zoom into this idea, very much along the same lines of Denari, when you think about what will we be able to do with stablecoins. Obviously, you can buy and sell them and you can hold them. But I think coming up next, you'll be able to buy and sell securities through something like Denari, or you'll be able to lend those stablecoins into like debt capital markets that sit on chain. So that's what many protocols of the likes of Morpho, Aave, Euler have pioneered over the years. Obviously, there's a ton of complexity that comes with that. There's risk, there's monitoring, there's compliance that needs to be baked into these systems. We think the companies of the likes of Stripe and many others that have wallet infrastructure, they're going to want to come to their partners with a full suite of services that are a part of that. So I think coming up next, and what we're particularly excited about and have been for some time, is like what does a yield abstraction look like in a way that a customer can access stablecoins through Stripe and can have them earn in a way that they don't have to worry about, am I getting the best sort of bang for my buck? Is this the best risk-adjusted return? Is this compliant? Is this secure? All these questions that I think arise, initially by the customer and then eventually by, the business or the developer, I think need to be addressed by a set of APIs. So we've made a couple of investments, one of them being called Superform, the other one's called Concrete, where they aim to address this complexity by offering structured products and offering a set of APIs for different developers to integrate their stablecoin infrastructure to, as well as for maybe the next wave of asset managers that they find ways to make stablecoins productive to kind of plug into their systems and distribute their products down to the likes of Stripe.
Thanks for that one. I appreciate also how you tied the trend into some of the companies in your portfolio. And before I let you go, I mean, we've had a few IPOs. We're going to have a few more IPOs. Some of the early stage crypto companies, whether it's IPO or M&A, we're seeing some exits here. And I guess from your perspective, what differentiates the ones that are able to get to the stage versus the ones that aren't? Like what makes the winner? Like what does that window look like? What is the path to exit?
Yeah. There's a whole set of companies that I think we're keeping tabs on that are coming to market. I think what we saw from Circle is that the IPO window is open. I think what's very clear is obviously cash flows and like a strong business model, even if it's not directly in place today, it's obviously first and foremost. I think there's an opportunity cost to investor capital, and there's only so much speculative capital that's willing to chase narratives. But the narrative is also heavily important. At the end of the day, our vote of confidence in buying such a stock ends up being just kind of the structure that ends up being prioritizing this common belief of, hey, stablecoins are going to be huge, even if the bottom line doesn't necessarily appear to be show that to be the case just yet. That narrative ends up taking center stage, and for many companies, I would argue that maybe if they do have the business model, maybe if they are growing, you need to have both, right? You need to have a strong business, you need to have a strong narrative, and something that really aligns investors to getting excited about this. That's primarily kind of what we're looking for, at least at that stage. But obviously along the way, there will be lots of M&A and lots of opportunities to partner with bigger companies that want to bake this infrastructure as part of their current offerings.
Well, it was great talking, and thanks for joining us on the Tearsheet podcast today.
Of course, thanks for having me, Zach. Appreciate it.